Hi, this is Ruth from Property Sisters UK channel. We welcome the lovely Helen Chorley, who's laughing at me, but that's just normal. So we are talking, the Bank of England talked about negative interest rates this week. So we want to do a little bit of a deep dive into it. As I said, we've got the lovely Helen Chorley with us. Let's just have a look at what Martin Lewis had to say first of all, and then we can come back and have.
Okay, so the first thing to say is it's if. It's very much if. What happened this week is the Bank of England wrote to the High Street Bank to say if in the unlikely event we were to cut UK interest rates so they were negative, are you technically prepared for that to happen? Now, even if that were to happen, that doesn't mean savings rates, or certainly not all of them, would go negative, as they tend to be, the best ones at least, substantially higher than the Bank of England base rate. So I would say it is unlikely that will happen, but it is more plausible than it was before that it could happen.
Okay, Helen, that's really interesting what Martin was saying there, because the papers are kind of making out that we are heading for the negative interest rate. Can you just explain a little bit more about what is happening for mortgages and for savers? Over to you.
Sure. So the Bank of England is checking with banks. You know, they're putting the feelers out. I wonder, I probably think it's a little more likely than Martin is saying. Perhaps he doesn't want to panic people, but this isn't something to panic about because this isn't unprecedented. Denmark has negative interest rates already, so this isn't kind of unusual. This isn't a UK only thing. What it does mean is that effectively, if interest rate goes negative, any savings that are in a bank, let's talk about the bank's own balance here. The bank gets effectively charged by the Bank of England to hold money. So in theory, it would charge you for having your savings with them. Whether that happens in practice, as Martin said, that's the unclear thing. So it's not clear at the moment if you will be charged for having your your savings with the bank. In terms of mortgages, it sounds like it would be a good thing, doesn't it? We go negative and effectively you get paid to borrow money. Unfortunately, that's highly unlikely to happen. I can't quite see that. But the thinking behind this is getting money out into the economy. We've seen all the quantitative easing that they're doing, getting money out into the economy, getting people spending, you know, really trying to grow and boost the economy, given how long it's been shut down for. So that's the reasoning behind it. It's that such that people don't sit on kind of, you know, sit on their savings, which actually, frankly, a lot of people have done over the past year. It's to get that money out in the economy and kind of get growth going again.
It's a bit like what you said earlier about the help to spend model what Rishi implemented, and whether you kind of like that scheme or not. It was about getting people out spending their money.
Exactly.
Yeah.
Exactly. So tax cuts normally do that. Tax cuts means more money in your pocket and you go out and spend it. You know, effectively what Rishi did with the eat out to help out, again, whether you agree with that it was right or not, was to get people out and get people spending, get money back into the economy. This is another way of doing that.
Yeah. Is there anything to be particularly worried about, do you think?
There shouldn't be. Like, actually, what is also underlying it is that we've got this quantitative easing, like the government has put so much money kind of into the economy, and effectively what happens is, in an inflationary environment, it means that that debt is effectively, it kind of becomes cheaper. It's getting paid off by the inflation. What that means for us, you know, kind of the layperson with money in their pocket, is that that pound at the beginning of the year is not going to buy as much as at the end of the year. So what it means is that you need to be looking for something you invest in that it gives you more than inflationary rate of return. But quite frankly, we've been in that kind of environment for a few years now, you know, with interest rates or savings rates so near zero that we're hardly getting anything anyway. So
it's 0.1%, right? It's barely zero. I mean, it's just it's
exactly. So inflation's been over that anyway. So you still have that effect. It's just if inflation keeps going up, and normally the Bank of England keep a hold on the inflation rate by kind of manipulating the interest rates.
Yeah.
They've effectively said they're kind of stepping away from that, or they're not going to use interest rates, increased interest rates, to keep hold of inflation.
I mean, what you said at the beginning is really interesting as well. You know, at this stage, they've only written to the banks to say, look, if we go negative in 6 months, prepare yourself, just get yourself ready, because you need to get your IT systems in place. Only if it's possible that ever happens. It may not happen, right? So,
well, it might not happen, but the way the Bank of England normally work is they don't like shocks to the economy. They don't like unexpected things to happen. So I personally feel like if they're giving indications now, they're getting us used to the idea. So in 6 months' time, we all don't go, oh my God, it's negative interest rates. It's like, well, that's old news, because we were talking about it 6 months ago. So I think if they're signaling now, I think it's more likely than Martin does, but hey, he's the expert.
It's clever, right? Because that kicks in with September, right? Which is the new school year. It's after the summer holidays. It's when COVID, we should all had our jabs by then. So that kind of ties in with the forecasting of what's happening this year in terms of coming out of COVID and then coming out of Brexit and all the rest of it. So it's kind of quite clever timing within that respect.
It is, and kind of not putting a date on it and kind of leaving it open-ended gives them that flexibility to use as and when they want to.
Do you think this is going to affect house prices in the next 6 months?
If people are feeling kind of richer and have more money in their pocket and want to get out there and spend, or actually are looking for returns, then it might put more money into the housing market. If you're not getting any money, any return on your money that's sat in the bank, why wouldn't you buy, a little house that's going to give you some yield kind of on the rental
It will keep mortgage rates low as well, presumably.
Exactly, so it still keeps things affordable. Now, people have to take into consideration kind of the tax effects, that we've seen with landlords, but people will be looking for where they can get kind of a better return. So I would just add that it's really worthwhile checking out Adam Lawrence's article that he's recently published it's on Facebook, the Partners in Property group. It's actually on LinkedIn. It's all over his socials.
I'll put a link down underneath. Yeah,
he explains it so well and talks about financial repression that not many people have been speaking about so far, and he makes it so easy to understand. So honestly, do yourself a favor. He suggests buying gold. I would suggest silver, but there you go. Financial advice.
Brilliant. Well, thanks ever so much, Helen. Really appreciate your time. And I feel like I definitely understand this area a little bit better. So thank you ever so much.
Pleasure.